What is up, my darlings and dudes? It is Taylor, and you are watching the Taylored Effect channel on YouTube. Today, I'm here to share with you all of our personal experiences from buying and selling a house through a contract for deed. So before I dive into the video, if you have not met me yet, my name is Taylor, and I'm here to share with you my personal experiences with money, sales, business, and just a really growing team, growing life. So here I am sharing these things with you, and today's video is about real estate and how you can use contract for deed in the future to either build your wealth or to become the seller on that side of things as well. So before I dive in, please consider subbing, please consider liking, comment your questions down below, and of course, find me on my other channels because, you know, I've got lots of content. Contract for deed. That is what everybody's wondering, okay? A contract for deed is basically a contract that you are entering into with the buyer and the seller. What this means is that the seller is essentially the bank in this situation. So instead of you going to a bank, instead of going to a credit union or some sort of mortgage broker, you would actually go into this deal with the seller as them being the bank. So instead of sending a check every month for your mortgage into, like I said, your bank or credit union, you send it directly to the seller. Now, contract for deeds work the best when that seller owns the property free and clear. That gives them the ability to actually have the flexibility to do so. If they don't own the property free and clear, it's very difficult to do a contract for deed because you would not only have to pay them, but then they would also have to pay their mortgage, and it would just kind of be this, you know, cascading thing that wouldn't really work out very well. So the contract for deed really works in only a few situations. So it's best if it is previously paid off by the seller and you're able to go into contract with the seller of the property based on them owning it free and clear. Okay, so Michael and I bought this house that we're currently living in about 2.5 years ago. And when we first tried to get into the house, our house is a $500,000 home. We're very grateful and fortunate to be able to be living in this house. But when we first tried to apply, it was right at the beginning of COVID. We did not have income history for Michael at that time because he was still within that 2 years of being self-employed. So we did not have the traditional means of being approved by the bank. In addition to that, we also had our other previous home that we lived in at the time. My parents is actually under my parents' name, so we did not even have that to list as an asset, even though we did have significant amounts of equity growth as well as money in repairs and updates to the home. So there was a couple things that were working against us, and that's okay. So what we did is we got creative. So if you find yourself in a tough situation or something that is just not really working out, please remember to always be asking questions. And it's not just to me to ask questions. Of course, I'm always here for questions, but it's also to the realtor. It's also to the sellers. It's also to the banker or the person who you're working on lending with. There's always a way. You can always make a way. And that's exactly what we did to move into this house because we absolutely fell in love with it. And I'm really grateful that we were able to do that. But like I said in the beginning of the video, there are a few things that need to go right in order for you to be in this situation in the first place. And that also included the fact that the previous owners, the sellers of the home, owned the property free and clear. They've lived here for their, 20, 30 years, something like that. They built the home. And that was really great because they had the ability to do what they wanted to. They did not owe any money to anybody else, so it was truly their decision on what they wanted to do. Now, the great part about contract for deed is that because the seller is the bank, they are also reaping the rewards of interest, right? And since us as the buyer at the time, we were going to pay interest regardless. We're going to pay it to the bank or to the sellers. So you might as well think about those in that terms. It's not like they're profiting significantly more because of that. It's just that they're the ones that are getting paid the profit versus going to a huge conglomerate bank, whatever, or even a credit union. It doesn't matter, right? So you were going to pay the interest anyways. So that part of it is not the issue. Another thing that we really liked was that it was a significantly lower amount of money down. Now, when you are in a contract for deed, of course, there's a contract, which includes lots of different stipulations that you as the buyer need to play within the rules of, or the seller owns the home back free and clear, right? There's always clauses and things like that where you could get some of your money back, you could get principal, whatever. There's lots of things that you could take a look at doing, but just as a gist, you typically pay less down and sometimes you pay a higher interest rate. So our purchase that we bought, we paid $480,000 for it. In the contract for deed 2.5 years ago, we paid $10,000 down, which is significantly lower than what the bank wanted us to pay. And if you can do the math on that, I'll just do it really quick here on my phone. They were asking at least 20% down, which means that we would have had to come up with $96,000 out of our pockets just to get into this home. Now, that would have been great had we, number one, had the down payment, and number two, had the other things, other stipulations like checked off. That would have been great, but that just wasn't the case. So because of this, we were able to get a significantly lower amount down and significantly around the same price point. It was a little bit higher of an interest rate at the time, that 4%, but we were more than happy to pay that because that meant we could get into the home, right? So of course our actual mortgage payment was higher because we had a higher principal, which the 480 minus the 10,000, so we paid 470,000 for the actual property, paid interest and principal on that every single month. And so with that, we also did what was a 2-year term. So as contract for deed, if you're looking at entering into one of these agreements, you have the ability to be flexible. So if you know, okay, I'm going to be able to get my crap together in the next 2 years, I'm going to be able to prove my income, I'm going to be able to save enough for a traditional down payment, I'm able to do this and do that and do whatever, then you are able to be like, yeah, this makes sense. You could also say, hey, I need 4 years, or hey, I need 5 years, or whatever that might be. You can come into the deal with what you would like as what you're asking. Now, for our property, the owners wanted to sell the house quite badly because they had it on the market for over a year and had not sold it yet. So we had a couple things working in our, in our favor in that aspect. And another great thing about what we were doing in our situation at the time is that we did not have to sell our previous home that we were living in order to move into this property. So of course, if you're buying and selling and you're looking at your primary residential home, you need to have your closings lined up, right? You need to have contingencies on, yes, I'll buy this house if our house that we're in right now sells within this time frame, and their house needs to fall within the time frame, and the contingencies just keep rolling. So contract for deed is a great way to avoid some of those things because you have more control over these small but significant things. So with this, we also were able to pay significantly less amount of dollars in closing costs, and we were able to close very quickly. So again, another great way to do this is to start asking questions. Start asking, how can I get into this home? How can I work with the sellers? How can I work on creative financing? And that's exactly what we did to be able to pay that less amount down. We did not pay any origination fees. We didn't pay any of those, additional application or any of those dollar amounts that sometimes we see the banks put in there, right, to help them cover their costs. And I'm not saying that's a bad thing. I think it's all part of the journey and the process, but there are ways that you can get around some of those things. And contract for deed is one of those ways. So if you just look at that from a financial perspective, you're saving a lot more on those things. In addition to that, you can close a lot quicker because it's just you and this person. You don't have to have all the banks and the mortgages and the things, all these other intricacies lined up 100% because it's just you and that person. You're entering into an agreement with that person as a seller, as a buyer and seller to say, yep, I'm buying this home, I'm paying you, I'm writing you a check every month, and at the end of the day, what happens is you then, at the end of that 2-year term or the end of whatever term that you agreed on, like I said, for us, it was 2. At the end of that 2-year term, we were able to refinance traditionally through a bank. Now, what happens at the end of that 2 years is your property has gone up in equity. So you have a bigger amount of gap that you have now in your home to be able to refinance. And you've also paid off a lot of that as well. So you've appreciated and you've built equity in that property. And now also through those 2 years, we were able to show more consistent income for Michael as well as me, and that growth, which obviously they're looking for. And we had more money saved for a potential down payment, of course. So if you're looking at some of these things to not only be the buyer on the situation, think about it from the seller's perspective. Now, if the seller were to close on the home and just be a traditional way of doing things, they would have gotten paid that $480,000, right? Minus the selling costs and whatever, the commissions and stuff. But this way, through doing a contract for deed, they're earning that money. They earn interest on it every single month. And at the end of the 2 years, they still get that same dollar amount of closing because the house is still worth, that's still what you agreed on, was that $480,000. So over the course of time, they earn tens of thousands of dollars of interest. Plus, they sold the home at the end of the day, at the end of the 2 years, and still earned that same amount of what they were paying or what they were expecting to take home from the actual purchase. So from an investment standpoint, as a seller, it is a really, really powerful tool to be able to put in place. Now, a few other things that go along with that, because I'm always thinking about the different layers and different things that happen with these transactions. You also have different tax advantages. Okay, so instead of having, let's just say you have $480,000, instead of a check for $480,000, you get a smaller amount of that, maybe $20,000, $30,000, whatever dollars per year for the next 2 years. And then you get that extra, then you get the full dollar amount on it. But from a tax perspective, if you're trying to plan out, okay, either retiring or you're planning for something big, maybe you've got a big expense coming up, something like that. If you're able to plan that a little bit, you'd be able to save significantly on the taxes and put more money into your pocket. Okay, so this is exactly what banks do every day, right? We get approached all the time to refinance, to take out a loan on our vehicles, take out a loan on this, take out a loan on that, and refinance and roll it over to this and do this and that and this and that. And the reason for that is because there's a lot of money to be made in interest. And the power that you have as the bank or as the seller in this situation is monumental. And that is exactly why banks are in business. They're in business to loan money. So if this is maybe not you in your situation right at this moment in time, maybe it could be something down the road that you look into doing, of being a lender, of being an investor in businesses and real estate and properties and things like that. The more people that I talk to, the more really wealthy people that I talk to, the more influential people that I'm in touch with, the more that I realize that they're all doing the same thing. Okay? And that's not a bad thing. That's a good thing. I'm just saying that it's kind of funny that, we see these things and we think about all the intricacies. I said that word already once this video. That's crazy that I said that twice. I don't think I've ever said that word in a sentence. Anyways, okay, so if you think about those things, what the banks are doing, the banks are lending out the money, they're making interest on that money, they're loaning out the money again, they're making interest on the money, they're making interest on the money that they made interest on, and they made interest on the other interest. And that's exactly what wealthy people do. So at the end of the day, of course this video is about money because I'm making it, but at the end of the day, if we're able to replicate and do what other successful things are doing, right? Like banks, the banking system in general in America, credit cards, whatever it is, there's a reason for that. And if we can start to see the reasoning for that and how we can actually do it on a real life basis, like this, for example, this is a lot of money, right? $480,000, $500,000 is a lot of money, but it's really not in comparison to the gajillions of dollars that exists in the world and that's in that's in circulation right now. But taking this dollar amount and seeing $480,000, not just that dollar amount, but the dollar amount every single month that we paid in interest and obviously principal, but the interest is really the biggest part of that, is that they already own the property. So they've already lived in it. They've already made their money, you know what I mean? Like off of living in it. And now they're able to turn around and have it be a powerful investment tool. So not only are they making money on it by owning it free and clear, but now they make more money on it because someone else like us, who didn't really have another choice to do so, is now paying their interest. So that's huge. And the sooner we can get to that point of being the seller in this situation, the point of being in power in this situation, the sooner that we're able to use that money to lend out, to make interest, to make interest, to make interest on the interest of the interest of the other interest. And that's truly the compounding effect that we can see in the wealthiest people in, you know, in the United States, in the world really, is like we're doing what the banks are doing, which is a very simple process. We're borrowing out that money. Somebody else is paying a premium to pay, somebody else is paying a premium to borrow. And so it seems like a really simple thing that you think, oh, well, banks are just like, it's just what banks do. Mortgages are just mortgages. But if you look at the actual dollar amounts associated with them of how much an actual mortgage brings in for cash flow for a bank through the lifetime of the loan, it's like astronomical. It's crazy. But this video is not for that. This video is about our personal situation with the contract for deed. And like I said, we did refinance earlier this spring. We got a really great interest rate. We got all these things taken care of and blah, 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 blah. But anyways, okay, if you have questions on contract for deeds, if you have questions on money, on real estate, on anything like that, please send me a message. Please write me a comment, whatever that would be. I would really appreciate reading it and getting back to you. So real estate, contract for deeds are great for real estate because you can have the flexibility. They're great for bigger properties because you, again, have more flexibility with that person who is the seller that you might not be able to be approved for traditionally. You can really start to push yourself and see what is truly possible. So appreciate you watching to the end of this video. Please subscribe and we'll see you on the next video very soon.